Good afternoon to all of our viewers and welcome to the July edition of the Bourse webinar series. And today we're taking a look at the economy and markets looking ahead into 2020. I think we can all agree that it's been quite a crazy 6 months. We're not hearing at all? All right, just bear with us for 1 second. We seem to be having some technical difficulties. The audio is good?
Okay, yeah. So it's just...
All right. Okay, so back on track then, some technical difficulties there. It's been a crazy 6 months over the past few months. And that has led to quite significant oscillation and fluctuation in both local and international equity markets, as well as bond markets. So what's in store for the next half of 2020 and perhaps into 2021? Well, today we're going to have some discussion on that. And in terms of housekeeping, some housekeeping suggestions. You can submit your questions at any time using the chat box in the lower right-hand corner of your screen. The presentation is going to take roughly 20 to 25 minutes, and we'll address as many of your questions as possible at the end. If not, we will be sending out a full listing of the questions asked with our answers as well. So today we're going to talk about, very quickly review the markets. Is it really a recovery or is it false hope? We're going to take a closer look at the local economy, in particular the mid-year update and what that would mean for the investment community. And we're going to look at some of those investor concerns arising out of the mid-year update, as well as the information that keeps coming up from the international markets as well. And finally, we'll take a look at what's next in terms of the investment outlook, as well as positioning your portfolio for the months ahead and perhaps even into 2021. So firstly, let's take a look at the local market. And it seems as though the market is indeed searching for signs. When we look at the equity or stock market in Trinidad and Tobago, we know that there has been some stabilization, albeit at lower levels, for the Trinidad and Tobago Composite Index, the All Trinidad and Tobago Index, as well as the cross-listed index. And that Trinidad and Tobago Composite Index has declined just around 10.7%, driven mainly by that underperformance of cross-listed stocks such as JMMB as well as NCB Financial Group, which would have been down in terms of the cross-listed index, down just around 20.5%. The All TNT Index, which is most of those companies domiciled in Trinidad and Tobago, has held up relatively well under the circumstances, down just around 5.3%. Now, when we look at some of the major movers over the first 6 months of 2020, in terms of top performers, National Flour Mills has been up just around 38.5%. And that would have been attributable to more persons cooking at home. I know I certainly did a little bit of experimenting in terms of cooking at home over that quarantine period, particularly when restaurants were closed. And that would have benefited a stock such as National Flour Mills. Republic Financial Holdings Limited also supported fairly well, up just around 6.3%, notwithstanding a fairly significant reduction in earnings in its reported results up to its 6-month period. Trinidad Cement Limited surprisingly was up just around 5%, despite a fairly lackluster economy and that period of prolonged period of shutdowns, which would have had some impact on the construction industry. Answer Merchant Bank and First Citizens rounded out the top 5 performers, up just about 3% respectively. So the banking sector and non-banking finance certainly having some representation in that top 5. On the other end of the spectrum, GMMB and NCB Global Finance down 24 and 27% respectively. And that is perhaps reflective of some concerns about the Jamaican economy, which does have a fair degree of dependence on tourism and the impact that the shutdown and closure of borders would have on the Jamaican economy. Unilever Caribbean, TTNGL in the energy space, and One Caribbean Media also in the top, well, the lowest 5 performers, down 26, 27, and 35% respectively. So that's the top performers. In terms of sector performance on the local exchange, well, it's all red all across the board for the first half of 2020. The manufacturing sector was down 13.2%. Trading was down 2.4%. Conglomerates, which includes Massey and Answer McCall, was down 10.8%. The banking sector, despite having some performers in the top 5, was down 9.5%. The non-banking finance sector down 11, well, almost 12%, and energy, of course, represented by TTNGL, down just 27%. So not very good reading, especially when compared to the 2019 performances, which were all high single digits, with the exception of non-banking finance and energy sectors. So that's the local equity market. What about the local bond market? Well, there hasn't been really any major public issuances for the general public to access to talk about, but TT dollar bond yields have been creeping a bit higher. That the 10-year marker is currently 4.66% in terms of yield that an investor could get if they were able to purchase a 10-year government bond. At the 12-year mark, it's currently 4.96%, and just at the start of the year, that was 4.84%, so just a 12 basis point increase. But the general sense here is that it has been fairly stable in terms of interest rates or government bond yields for the first half of the year, which may be rather surprising given the expectation of significant increases in debt or additional debt that would have to be issued to fill the expected fiscal gap. More on that later. And some of the key characteristics of the TT dollar bond market, well, the main question for investors is, will more TT dollar bonds become accessible? The last major public offering, as mentioned, would have been the $4 billion worth of NIF bonds way back in 2018. There has admittedly been increased private issuance from the government as well as government guaranteed issuers, but these have really been focused on institutional buyers in the main. So not really available to general public, but more so for institutional portfolios. And of course, there's been a lack of exchange-listed bonds. Most of the bonds being issued, or pretty much all of the bonds being issued, in fact, have been over the counter. So there's no readily accessible market for these bonds that is observable. So that's a look at the local scene. Internationally, well, it has been a very good second quarter, but the question is, can this recovery last? And we have seen, particularly in the international markets, a very strong second quarter performance or recovery, to use that term fairly loosely, of equity markets. And when we look at, in the US, for example, and we are looking at investable exchange traded funds, the SPY, which replicates the US equity market, that would have recovered 19.6% in the second quarter of 2020. Still, at the half-year mark, US markets were down just around 4.2%. Asia ex-Japan, as measured by the AAXG exchange traded fund, also advanced 15.8%. However, year to date, at the halfway mark, it was down just still about 5.9%, with a similar trend for European exchange traded funds, down 14.3%, but up 15.3% in the second quarter of 2020. And Latin America, after dropping almost 46 to 47% in the first quarter, recovered 18.1% in the second quarter, but still, nevertheless, down around 37% at the halfway mark of 2020. So not very good reading for investors in the Latin America, European, and to some extent Asian space. The US has seemed to hold its own for now. And again, the major question is, will it continue to recover? In terms of bond investors in the international space or US dollar space, Well, it has been, a 6-month period to broadly forget. Investment grade bonds, as measured by a total return index, would have been up just around 2.2%, whereas high yield or non-investment grade bonds would have actually declined on average by 2.3%. And that's in stark contrast to a very commendable 2019 performance, where they were up in very high single digits. The investment grade index up 8.7% and the high yield index up 9.2%. Well, let's bring it home a bit and talk about some bonds which most investors in Trinidad and Tobago who look at US dollar bonds would be familiar with. The Trinidad and Tobago 2026 US dollar bond, which offers a 4.5% coupon. We can notice some very wild fluctuations in prices for all of these bonds, which local investors may be a little bit more familiar with. So, for example, the Trinidad and Tobago 2026 bond would have started the year at around $107 per $100 face value in terms of pricing, would have climbed to a high of $108. At the peak of the crisis, would have fallen to as low as 84 cents on the dollar, and has now moderated to around $102 per $100 face value. So very wild fluctuations, and the same could have been seen with the Trinidad Petroleum Holdings 2026 bond as well. Started the year at 112, rose to as much as 114, fell to as low as 86, and is now trading around $102 as well. A similar case for TGU or Tringen bonds, as well as the NGC 2036 bonds, which are outstanding. So that is just a flavor to give investors a flavor of the wild swings that would have taken place in terms of bond pricing over the first 6 months of the year. So we have seen some measure of stabilization, albeit at lower prices. So that's a quick recap of the market. What about the local economy? And most investors and onlookers and economic experts are suggesting that tougher times lay ahead. But is it really? Well, let's take a look. For the fiscal 2020 revised budget projection at the mid-year review, revenues, as everyone would now be well familiar with, were revised downward from 47.75 billion to 38.5 billion, and that would have been a 9.2 billion shortfall in projected revenue. Expenditures, surprisingly somewhat, would have been maintained at around that $53 billion level. As a matter of fact, increased very slightly. And the fiscal gap, which is, of course, the difference between what we earn as a country and what we spend, would have widened from 5.3 billion to just around 14.5 billion. So it means effectively we are spending 14.5 billion more than we are projected to earn. So that fiscal gap as a percentage of GDP, a higher number is usually worse. It would have expanded from 3.2% to 8.8%. So certainly some deterioration in the earning capacity of the country. However, expenditures seem to be on track to stay fairly constant. Now, that's somewhat surprising given that government revenues are being constrained. And as we can see over the past 4 fiscal years, from 2016 to 2019, government revenues have been in the range of 36 billion in total to around a high of around 45 billion, which was back in fiscal 2016. And really, the main driver in terms of fluctuation has been that yellow segment there, which is in fact energy revenues. And energy revenues would have grown fairly consistently from fiscal 2016 to fiscal 2019. And we would have seen some fluctuation also from non-energy revenues over the same period, with a low of 26 billion but most recently in fiscal 2019, and a high of 34.5 billion way back in fiscal 2016. And in the first 6 months or the first half of fiscal 2020, the total revenues are projected at just around 17.5 billion, which is roughly 50% of projected revenues for the full year. So certainly a picture of constraint in terms of revenues earned by the government over the past few years, which would necessitate some which would rationally necessitate some control in expenditure. Now, this constraint rather of revenues would have been driven in large part by the energy sector and its trickle-down effect in addition to its direct effect. And we can see crude oil production has fallen from 72,000 barrels per day in 2016 to an average currently of around 58,000 barrels year to date in 2020. When we look at crude oil prices, we can see that prices would have, or average yearly prices would have increased over the 2016 to 2018 period from $43 to about $65 a barrel, and it has now steadily declined. And year to date, the average price of crude oil, as measured by West Texas Intermediate prices, is currently just around $37 per barrel. So certainly not headed in the right direction. And the forecast for, or rather the outlook for lower growth, certainly won't support or be very supportive of any measurable rebound in prices. In fact, for 2021, oil prices are forecast to be in the region of just about $43 a barrel, and that was by the Energy Institute in terms of their particular forecast. And the same sort of trend would have materialized over, well, in the case of natural gas. Now, while there was some recovery in terms of production of natural gas in 2018 and 2019, from a low of 3.3 billion cubic feet per day in 2016, it hasn't reached quite the heady heights that were forecast maybe back in 2018 to 2019, where production of natural gas was expected to peak at around 4.15 BCF over the 2020 to 2021 period. So certainly that production, we're well short of that production. And to top it all off, we've seen somewhat of a mini collapse in natural gas prices. And this is admittedly Henry Hub prices falling from a high of around $3.20 per MMBTU back in 2018 to currently its year-to-date average of $1.80 per MMBTU for 2020. So definitely not going to really help the energy configuration or the energy revenue configuration. And on top of that, when we look at downstream prices for methanol and ammonia in particular, these would have actually contributed to a decision by several of the major plant operators in Trinidad and Tobago for the temporary closure or prolonged closure of several of their plants. Yara's ammonia plant would have been closed down. Methanex's Titan plant, the M3 and M2 by MHTL, and Nutrien would have closed some of their plants, as well as Tringen most recently, taking a decision to close this plant, albeit temporarily, but because of fairly unfavorable commodity prices for the commodities which they produce. So the revenue picture doesn't seem quite favorable, at least in the very short term, and that has led to several investor concerns. And some of these major investor concerns would include growth, access and availability of foreign exchange, government spending, the level of government indebtedness and what that could do to our overall fiscal position and credit ratings, as well as the direction of interest rates locally. So let's take a look at each of these individually. And the big question is, can growth recover? Well, the IMF for Trinidad and Tobago would have predicted a decline or contraction in the economy of, in real GDP terms, of 4.5%, which conflicts to some degree with the Ministry of Finance's projections of a 2.5% contraction. Now, in 2021, the IMF also sees Trinidad and Tobago recovering by 2% or 2.5% roughly in terms of growth of the economy. The Ministry of Finance would have projected somewhat of a more aggressive growth projection of 4.7%. But if we look historically, we can see that we would not have registered a positive growth in real GDP terms for a single year since 2016, with a negative 6.3% in 2016, negative 2.3% in 2017, negative 0.2% in 2018, and we seem to have been breaking even in 2019. But COVID, unforeseen as it would be leading to an almost certain fairly significant negative growth number in 2020. So can growth recover? In the near term, it seems unlikely. In 2021, perhaps there should be some moderation, but it still won't take us out of the hole that we would have slipped into with several years of consecutive negative growth. It would take several years of even stronger positive growth for us to even break even in terms of the high point or the peak of real GDP that would have been produced by the country up to 2015 or thereabouts. Now, access to foreign exchange and availability of foreign exchange affects investors in two ways. One, investors may wish to look outside to provide some diversification from a currency perspective to their investment portfolios. And secondly, there may be greater opportunities internationally to grow your wealth through investments, given the fairly lackluster environment that has been taking place in Trinidad and Tobago in terms of economic activity over the past few years. So just to put it in layman's terms, I can't buy Apple stock with TT dollars. I need US dollars to do so. And that has been a seemingly never-ending challenge for investors over the past few years. And this particular chart would typify that, would illustrate that to some extent. Authorized dealer purchases of Forex from the public in red, so that's what companies and individuals might sell to the commercial banks and other authorized dealers, has been about average just around $3.5 to $4 billion, $4.25 billion US over the past few years. And sales of foreign exchange to the public has been closer to that $5 to $6 billion mark over the corresponding period, which has meant there has been a deficit of just about $1.5 billion odd US over the past 3 to 4 years, and that would have had to been filled by the central bank in terms of injections of foreign exchange into the banking system. That trend seems to be fairly intact on a year-to-date basis for 2020 as well. And speaking of injections by the central bank, we can see that net official reserves have continued to decline from the May 2016 figure of about 9.7 odd billion US to its current level of around 6.9 billion US. Now, take that with a pinch of salt. It has been a fairly steep decline, but even with that steep decline, that 6 to 7 billion odd US figure includes the impact of borrowings, international borrowings, which would serve to support that international reserve figure, as well as drawdowns from the Heritage and Stabilization Fund, the most recent of which was a US 400 million drawdown in May, with subsequent approval for another 200 million US over the coming weeks or so. So without those one-off injections, that net official reserves figure could be even lower, which may be of some concern to investors and certainly would not aid the situation for investors who may be looking at opportunities internationally, but be short of US to take advantage of those particular opportunities because access to currency is likely to continue to be restricted. Now, that one of the good things that the local economy has going for us right now is that Heritage and Stabilization Fund. And as at the end of May, it was in excess of $6 billion, even with the most recent withdrawal. As we can see in terms of this red shaded area, which are net contributions, we haven't really, as a country, made significant contributions or any contributions, in fact, to the fund for the past almost 8, going on 8, maybe perhaps 10 years. And really the fund has grown because of a fantastic run in equity markets and in the investment portfolio, which would have allowed the fund to grow fairly significantly to that 6 billion mark, most recent mark, as of the end of May. Now, with continued uncertainty in international markets and the potential for some volatility, the position of the Heritage and Stabilization Fund could come under some pressure or strain with valuations falling. It is, however, a long-term fund, and we would hope that it continues to move upward. But again, the lingering uncertainty from COVID as well as other economic factors could make that or could put that particular direction at jeopardy. So, can expenditure be contained in the context of lower revenues at the government level? Well, over the past few years, fiscal years, we have seen a gradual reduction in expenditure from around 53 billion in fiscal 2016 to around 44 billion as of fiscal 2019. However, there are some fairly sticky elements of which comprise expenditure, which would be very difficult to cut, at least in the short term, without creating some pain for the general population in terms of adjustment pains. And those would include transfers and subsidies, which has moderated a bit to its current, well, fiscal 2019 was around 24.5 billion. At the half-year mark, it was around 12.5 billion. So carded to be pretty much in line with fiscal 2019. We have seen a consistent decline in goods and services spending from 7.3 to 5 billion. Wages and salaries have remained fairly constant and will probably get to close to that 9 billion odd mark again for fiscal 2020. Capital expenditure may be curbed to some extent as well as, but interest payments because of greater debt is likely to expand. So some difficult decisions may have to be made over the coming years to right the ship that is Trinidad and Tobago in terms of moderating expenditure in the absence of significant growth in revenue. So that's another concern of investors, and that is intricately linked to the question of debt and indebtedness at the corporate, well, at the sovereign level. Now, at the mid-year review, the Honorable Minister of Finance did mention that debt to GDP is forecast to hit that 70% figure for fiscal 2020, which is in terms of an initial reaction, somewhat concerning for investors and economic onlookers. In fiscal 2013, we were at just about 40% debt to GDP. For the period 2017 through 2019, we were just around the 60% level. So moving from that 63 to 70% level in the space of 1 year is perhaps somewhat concerning. The Minister of Finance did mention that there would be some expected moderation to 2023 back to the level of 63%. The question as to how we would be able to get back to that level is another matter entirely, given expected constraints in terms of government revenues and the likelihood that further fiscal deficits would have to be met through borrowing. Now, in that context, 70% debt to GDP sounds alarming, but when we stack it up against some of our comparables across the region, it's actually not it's not a bad figure. It's fairly reasonable. Barbados and Jamaica, perhaps the outliers, they were in the hands of the IMF or are in the hands of the IMF. Their debt to GDP levels are around 110% for in the case of Barbados and around 93% for Jamaica. Mexico, on the other hand, which has an investment grade rating, is around 61%, and Brazil, which has fallen out of the investment grade rating status, is around 98%. So a 70% figure is not, again, with context, is not necessarily the end of the world. However, it is something that we as a country and as investors should be keeping an eye on, because it puts our credit rating at risk of downgrade. And for those of you all who are particularly more familiar with our credit rating status, we have lost our investment grade rating from Moody's, and we are just on the borderline of investment grade with Standard & Poor's at BBB-. So certainly something to keep an eye on, but again, we're not in a dire position as of right now. And finally, in terms of investor concerns, where will local interest rates go? Well, We have seen earlier in the presentation that interest rates would have climbed to some extent, very marginally over the first 6 months of the year. Certain decisive actions by the central bank, guided by the Ministry of Finance to some extent, would have served to basically put a lid on very sharp increases in local interest rates. And two of those measures that were put into action were, firstly, the reduction of the repo rate from 5% by 150 basis points, or 1.5%, to a current level of 3.5%, which effectively signals to commercial banks that they needed to lower their rates, their lending rates, and promote lending just generally throughout the economy. The second measure that was taken was a cut in what's known as the primary reserve requirement from 17 to 14%, and the estimated impact was that it would free up an additional 2.6 billion TT dollars in the banking system to be available for lending. So we have seen excess reserves, and excess reserves is basically a measure of cash that banks may have that do not have to be lodged at the central bank. That would have climbed to around 8.3 billion in its most current date of recording. So we can see continued liquidity in the system, and usually the rule of thumb is more liquidity generally means lower interest rates or more stable interest rates at the very least. It also gives the government the opportunity to issue more private issuances or more bonds, which should be absorbed by institutional buyers and hopefully individual buyers at some point if a public auction does become available because of this excess liquidity in the financial system. So naturally, the next question is, what's next? We've taken a look at what's happened. We've looked at the economic position of the local economy, and we've looked at some of the major investor concerns. So what can we expect going forward? Well, that's the almost $1 trillion question. I mean, if I had all the answers, I'd be fairly wealthy, and I'd definitely share it with everybody. The local market outlook, well, that increased indebtedness, that increased debt to GDP, that the likelihood of that occurring is going to be, well, it's on the higher side. So it's more than likely that we'll get to that 70% level sooner rather than later. And that, in general, would not be a vote of confidence for investors. It would actually dent investor confidence a bit. Economic growth is likely to be on the lower side. In fact, it's likely to be negative. Well, it's almost certainly negative in 2020. And whether or not we as a country recover and do generate even the lower end 2.6% figure of the IMF in terms of growth in 2021 remains to be seen. And that also would result in lower investor confidence. Interest rates, the likelihood of a very supportive monetary policy to stoke lower interest rates means that lower interest rates are more likely to be here for longer. In terms of what that does for confidence, well, it's sort of a double-edged sword. On the one hand, lower interest rates generally tend to stimulate lending. However, banks are not going to just lend for the sake of lending. They would also want to make good loans, and that will be more and more difficult to achieve in an environment where unemployment is ticking upwards. Business activity is also slowing down, and therefore that may not necessarily improve investor confidence. Lower interest rates, that is, in the short term. Lower corporate earnings by reporting companies, publicly listed companies in the main, is likely higher. We've already seen some of those major companies register lower earnings, and that's not going to really help investor confidence too much, and that has been reflected to some degree so far in the stock market performance. As mentioned, the Trinidad and Tobago Composite Index down just over 10%. And weaker energy markets, the likelihood is higher by all forecasts that have been provided. The Minister of Finance did mention that the fiscal 2021 budget, at least at that particular point in time, was going to be premised on a $40 per barrel price of oil. And that is going to probably lead to lower investor confidence as well, because production remains constrained and prices are seemingly going to be suppressed for, well, at least in the near to medium term over the next 1 to 3 years, given the lower growth outlook at the global level. So that's the local market. Internationally, well, there are several factors to consider. Near zero interest rates, the likelihood is much higher. In fact, the US Federal Reserve would have mentioned that interest rates are going to be kept low at least until 2021 to 2022. And that generally tends to boost confidence in equity investors, in the mind of equity investors at the very least, because it creates a low yield environment. And what we tend to find is that money that would ordinarily be invested in fixed income markets tends to find its way into equity markets in search of dividend yields, which tends to be supportive of equity prices. Credit rating downgrades, definitely on the higher likelihood end of the scale. And that is going to probably be a dent in terms of investor confidence. Now it's in the middle mark here because the Federal Reserve would have basically created an unlimited bond buying program, at least for US companies, which creates some measure of comfort for fixed income investors in US companies. The threat of a second wave of infections, well, this is where it all started. COVID-19 would have led to a health crisis, snowballing into an economic crisis and a financial crisis. And that seems to be, again, middle of the fence, that threat of a second wave. We are seeing rising cases in the US as well as other major countries. However, as time elapses, we are undoubtedly getting closer and closer to the formulation of a successful vaccine. And certainly the announcement of a successful vaccine is likely to boost investor confidence. Will it boost it beyond the very significant recovery that's taken place in equity markets thus far? One never knows. But that is certainly, that threat of a second wave is certainly sort of, we're probably hanging in the middle in terms of likelihood, given that the race for the development of a vaccine is well and truly on. US and China trade tensions, likelihood is lower. At the start of the year, it was a pretty big deal. But in light of all that's happened thus far, and with US elections coming up, that particular stance or standoff between the US and China could change fairly quickly. The main driver of US market outlook and the wider global market outlook is prolonged global low growth. With the advent of COVID-19, industries would have changed almost permanently. New industries would have emerged. Some traditional industries may be on the ropes, including in dining, restaurants, etc. Events and entertainment industries certainly on the ropes. And that prolonged global low growth, if it's a higher likelihood, which it seems to be, could dent investors' confidence to some degree. Now, finally, in terms of portfolio positioning, well, usually we have three investor categories: the conservative, moderate, and aggressive investor. We've added a fourth, the ultra low risk investor, where in times of heightened uncertainty such as these, this type of investor typically tends to opt for only the safest investments. So what would that portfolio look like if you are positioning as the ultra low risk investor? Well, you would probably have about 50% of your portfolio in cash or near cash instruments, 30% in bonds, and if you have access to US dollars, maybe 20% in international bonds, 10% in local, and another 20% allocation in international stocks. In terms of what type of assets you'd be choosing, you would be choosing in the international bond segment very high credit ratings or credit quality issuers, and they could be either corporate or government. When you're looking at international stocks, you would be choosing bonds that are high value or value-oriented stocks, rather, which are higher on the end in terms of dividend yield and also lower in terms of PE ratios or price earnings. So you're getting relatively cheap, I've used that term loosely again, cheap stocks, which give you good cash flow in terms of dividend yield. In the local bond space, it's pretty much a no-brainer. You would be sticking to high credit quality issuers. For example, the government of Trinidad and Tobago, in TT dollars, you wouldn't be able to get a higher credit quality issuer than the government of Trinidad and Tobago, as well as a high credit quality corporates. So, for example, a First Citizens Bank, Republic Financial Holdings, etc. Very high credit quality, very stable, very well capitalized issuers of bonds. And in the local stock sphere, you would also be looking at companies with lower price to earnings ratios and higher dividend yields. That might be somewhat difficult to achieve in the current environment, given that several companies, rightfully being prudent, have opted to significantly reduce or even eliminate their dividends being paid in light of what's going on with COVID. The conservative investor, a slightly different approach to investing, just around 30% of your portfolio in cash or near cash. And by cash and near cash, we mean income funds, which are fixed NAV, or repurchase agreements, not necessarily cash in the bank, because that is pretty much a sin, having your cash in the bank earning zero. So we're talking about cash and near cash. We're talking about fixed NAV funds as well as repurchase agreements or the like, or fixed deposits, for example. Just around 50% of your portfolio overall in bonds, with a nice mix of international bonds as well as local bonds. Again, the caveat is if you have access to foreign exchange, and just around 20% of your portfolio in stocks. Again, in the international bond segment, you're looking at higher credit quality issuers, and you're probably skewed towards, well, you're being different in terms of government or corporate issuers at the international level. In the local bond space, of course, the government is the highest credit quality, as mentioned. On the corporate scale, you could go a little bit lower, not going to call any specific names in terms of lower credit quality issuers locally. International stocks, again, focusing on, there's a value bias, looking at higher dividend yields and lower PE ratios, but you may want to take a bet on probably some very large cap stocks, or perhaps an index exchange traded fund such as the SPY. And in terms of local stocks, again, sticking to that value bias. Moving on to the moderate type investor, we would note that you'd have even less of your cash or near cash invested as part of the portfolio. So just around 15% of your portfolio perhaps invested in cash and near cash. A larger component of bonds, 45% in total, between international and local. Again, if you have access to that particular very valuable commodity that is US dollars, and around 40% in international and local stocks. For international bonds, you can get a little bit more, the moderate investor gets a little bit more adventurous, perhaps venturing into that non-investment grade rating area. And for example, the Trinidad Generation Unlimited Bond, or even Sagicor bonds, are non-investment grade, but fairly well-established companies, stable companies that we know and are familiar with. So perhaps they would be along the lines of those non-investment grade issuers that the moderate investor would be looking at, as well as borderline investment grade securities or bonds as well. In the local bond space, pretty much it's what's available at any particular point in time with respect to government bonds and or corporates. High credit quality corporates, I failed to mention, would have been bonds such as the NIF, in addition to First Citizens, Republic, again, if they are available to you. In the international space, the moderate investor may want to take a look at stocks such as maybe a Netflix, Amazon, highly valued in terms of their price to earnings ratio, but definitely more on the growth spectrum, don't pay a very attractive dividend yield, if any yield dividends at all. And on the local space, a similar case. Up until recently, that would have been the NCPFGs, the GMMBs with low dividend yields, but high growth potential, again, until recently. And finally, the aggressive investor, which is definitely not me. International bonds, very speculative grade, probably looking at distressed assets. If in this particular environment you're looking at bonds with a 10 to 15% yield to maturity, you might be an aggressive investor. Definitely non-investment grade tends to be what the aggressive investor looks at. Just a very small allocation to cash, and near cash 5%. Most of their portfolio is invested in stocks. Now, in terms of the local bond space, again, not too much to mention there, but in the international stock space, these are investors who may be investing in penny stocks, stocks for the future, IPOs, biotech companies, things that have very high risk but very high potential returns involved, and that's what the aggressive investor, when we're talking about international stocks, might be focusing on. And local stocks as well, perhaps more on the IPO side or recently issued. However, these are few and far in between. For example, Cinema One may have been an example, perhaps Endeavor Holdings. So along those lines, in terms of stocks that are more aligned to growth as opposed to value stocks offering a reasonably good dividend yield. So that's how you'd probably want to position, or each of these different types of investors would want to position their portfolios. Some caveats: always consider your specific conditions, your investment time horizon, your liquidity needs. So there's an old saying, don't invest your grocery money in the stock market or the bond market. So, this has to be capital that you could reasonably put away for a fairly long period of time. If not, you would want to skew towards cash or near cash investments, and that ability to monitor your investments, particularly in an environment such as this, where stock prices, bond prices have been fluctuating fairly widely over the past few months or so, and it may be expected to continue to do so over the next couple of months at the very least. So with that, I think we have come to the end of the presentation. I hope everyone has enjoyed it, and we are opening up the question and answer session. I see my team has been quite busy collating some questions along the way, so I'm going to try to address some of these questions. So let's see if we can pull up the first question there. And the first question is, if TNT were to float freely, what would the equilibrium or true exchange rate what would be the equilibrium or true exchange rate in terms of USD to TT dollars? All right, so that is a quite interesting question, and certainly not a question that I could answer with any specificity at this particular point in time. The reality is, the market, it has to happen for us to know where the equilibrium exchange rate would lie. We can, however, look at some gauges of where investors have been accessing US dollars in terms of a gray market. Looking at the CAMU rate, for example, at the airport, well, at least until recently, and we would have noted that the CAMU rate would have been anywhere from 8 to 8.70 or thereabouts in terms of buying US dollars. So that might give us some clue as to what, or selling US dollars rather. So that might give us some clue as to what the free or floating exchange rate might be. In terms of monitoring, for example, asset prices between markets. So for example, asset prices between Jamaica and Trinidad, we could derive effectively what an effective exchange rate might be. And in similar vein to the CAMU ranges, that effective exchange rate typically lies somewhere between $8 to $9, maybe as high as $9.50, thereabouts. So if it were to float freely, I would imagine definitely not, not in the low sevens, probably closer to 8, perhaps 8.50 might be a reasonable region before, and that would really be sort of a clearing level with some perhaps panic buying taking place before it moderated. So I would say probably between the 8 to 850 level. Okay, the next question is, what is the possibility of the TNT dollar getting devalued? Well, as we would have mentioned in the presentation, we have seen perhaps concerning trend of our international reserves on the decline, albeit we are still at very healthy levels by international standards, just about 8 months of import cover, and the international standards is just around 3 months. But the trend has been downward and declining, and that is with support from borrowings that has been and drawdowns from the HSF, which have gone into those international reserves. So the likelihood, it's probable. It all depends on how quickly that the international reserves are being depleted. The trend has been almost linear for a while, and I would say it's likely. Timing of that particular devaluation or re-evaluation is perhaps uncertain, but definitely not within the next, I would say, 2 to 3 months or thereabouts. The next question, do you have any view on the US bond market? Can we expect any growth in the next fiscal year? Okay, so those are two separate questions. So do you have a view on the US bond market? All right, so the view on the US bond market is for US bond issuers, because the Federal Reserve has instituted for the foreseeable future unlimited bond buying program, that there will continue to be new issuances, and that there will continue to be support for bond prices, at the very least for US bond issuers, US companies that are issuing bonds, to be more specific. For the emerging market, investor, the dynamics are a little bit trickier. There is no support program that says, for example, if Petrobras issues or Trinidad and Tobago issues US dollar bonds, that somebody will buy those bonds. That definitely is not the case. So you are taking some risk. I think the fact that the Trinidad and Tobago was able to issue a new 10-year bond at 4.5% recently to the tune of 500 million US was quite commendable in the sense that it was excellent timing. As things continue to develop, particularly with our economy, and perhaps if the economy deteriorates as it is expected to, at least over the next 12 months or so, as a country, we may not be able to access that level of competitive financing on the open market for some period of time. So in terms of the view on the bond market, some US dollar, US company issuers should have some support. Emerging market or non-US issuers are going to continue to issue in this low interest rate environment, but they will not have that safety net below them, that is the US Federal Reserve. So continue to stick to higher credit quality issuers and continue to stick to companies that have fairly stable business performance and cash flows, particularly over the past quarter or so, and in the next quarter or so, which will give you some level or some indicator as to their financial strength to be able to weather any prolonged period of low growth at the global level. Next question, government expenditure. What exactly does transfers comprise of in transfers and subsidies? Well, that comprises government transfers to educational institutions. It would be transfers to households, state enterprises, statutory boards, So basically, whatever it takes to keep the country running, which is non-productive transfers of funding. So, for example, a social grant that would have been given over the past few, well, perhaps during COVID, would count as a transfer and subsidy. A subsidy could also be the funds that are provided to utility companies that may be on its own operating at unprofitable levels. Okay, next question. Which US candidate is better? Wow. Which US candidate is better for the markets and the US economy as a whole? This webinar is being recorded, so I'll be very careful about what I say. The incumbent president has been viewed as pro-business generally and very supportive of financial markets, and that has been evidenced by the performance of US equity markets over the past, during his term, as well as the extraordinary measures that were put forward, particularly at the height of this COVID-19 crisis and its impact on financial markets to shore up the equity investor confidence and bond market investor confidence. So the major contender is not viewed as positively. However, the incumbent, President Trump, may be viewed by some as being perhaps a little bit contentious, a little bit non-traditional in terms of his approach, and therefore I would say it's a toss-up. In terms of policy, thus far, the incumbent president has been quite supportive of financial markets, but his style may not have been, or may not be, perhaps the most well-received by many. Okay, let's move on from that question. The next question, how can a local resident purchase US stocks? I asked this because you have mentioned getting Amazon, Netflix stocks. Okay, well, that's a perfect segue into our advert for our Bourse Trader platform, all right, which basically allows investors to access international stocks. The one point is that you have to work with your US dollars because accessing US dollars from the bank is as challenging for us as it would be for anyone else, because we are an investment company and not necessarily a distribution company or the like. The next question, what local stocks may be best to buy for dividends and or growth? It's been a very tough year, and the next 12 months or so make with the forecast is even murkier, I would say. When we think of companies that have traditionally been, as predictable as you would imagine in terms of paying a dividend, for example, Answer McCall and Republic, they would have slashed their dividends. In the case of Republic, by more than 50%, the interim dividend, because of the impact of COVID. And Answer McCall, I believe, would have omitted their final dividend in entirety. Companies such as Prestige Holdings also would have foregone their dividend payments. So under the current circumstances, it's a bit more difficult to predict, which companies are going to be really good in terms of paying a dividend. NGL also would have slashed its final dividend from $1 to, I believe it's 25 cents per share most recently. So the traditional dividend paying stocks under the current conditions have been, breaking tradition. And therefore, to say with in any definitive sense that, these stocks are going to be excellent in terms of providing dividends would be a little bit premature. However, from a growth perspective, the banking stocks typically tend to do well, notwithstanding the current conditions. There is an argument that could be made for TTNGL, for example, that it is a stock in a cyclical industry and it's probably at the down cycle. Whether or not it's at the lowest point of that down cycle in energy markets is another question. But certainly, this is a stock that would have been at about $30. It's come down to around under $17 right now. It may be one particular stock that could be looked at. So another question. Should investors be considering investments in non-traditional markets? Should we be divesting out of the US into more European or Asian markets? Now, that's an excellent question in terms of investment allocation. And what we would note is that, yes, you can consider it. However, when you go into an Asian exchange traded fund or a European exchange traded fund, for example, you are taking on the additional risk of currency. So even though you might buy an ETF with US dollars, built into the performance of that exchange traded fund is the impact of currency. So if the euro depreciates or weakens against the US dollar, that performance is built into the price of the exchange traded fund that you buy. So yes, it is a measure of diversification. However, it's something that you need to time. Okay, so we're getting a lot of questions, and we may not be able to answer all of them in this live session. So let's just take one more. With the decline in the job market, increased prices for goods and services, and uncertainty in the international stock market, what advice can you offer going forward to investors to boost their confidence in staying invested amidst the COVID-19 virus? Oh, so that's a fantastic question. And it's all a matter of perspective. If it is the case that you're investing today and you would expect to have a return of 5 or 10%, let's say in the next 12 months, then you probably should be looking at safer investments like an income fund or like a repurchase agreement. And you won't get that 5%, but you might get a 3% or thereabouts. But you'd have that certainty. In this particular environment, you as an investor, your mentality should be for the long term. If you're picking up stocks at this particular point in time, you're picking up stocks that you'll be happy to hold for the next 5 to 10 years comfortably, that you're able and willing to hold for the next 5 to 10 years. Do your research, or we can help you to get the research, or at least some analyst ratings, and provide some general statistics. But in this particular environment, because of the heightened uncertainty, you should be thinking longer term as a horizon for investments. And so we have several other questions that would have come in. At this particular point in time, what we'd do is we would create a question and answer sheet, and we would email it out to all of those participants on this particular webinar by the end of the week. I would like to thank you all on behalf of our Bourse team who would have worked really hard to put together this presentation for joining us this afternoon. If you have any additional questions that you may not have put forward in this during this time, please feel free to submit them by the end of the day, and we try to get them answered and send them out by the end of the week. So again, on behalf of our team, I'd like to thank everyone very much for attending, and we look forward to providing more great information, advisory, and guidance to you all in our next edition of the webinar series. So thank you all, and have a really wonderful afternoon.